Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 16th of August 2024. So looking at the German DAX index, you can see that it has now broken its medium-term bullish trend line that had been in place since October of 2023. And it has also moved below the 21-day exponential moving average. These are clearly bearish technical indications that suggest the market could be heading lower, especially now that the index has broken key support here at around 17,850 area to 17,900, this shaded region where previously it had formed support. But following the formation of this inverted hammer candle that was formed on Monday, it looks like the latest attempt to stage a recovery has proven futile and that it could be heading lower, further lower in the next few days. So from here, the next level of support is not very obvious. I think 17,500 is a target for the bears, but eventually we could see a decline towards 17,000, which was previously a major resistance zone before the index broke above it in middle of February. So I think that's the main downside target. Will we get there? Remains to be seen. On the upside, if we go back above this shaded area that I mentioned earlier, then in that case, I think the bulls may have a say in terms of near-term direction. Specifically, a close back above the resistance trend of this bearish channel could pave the way for a fresh rally. So unless that happens, the path of least resistance is going to be to the downside. The S&P 500, having already broken its short-term bullish trend line, has fallen below the 21-day exponential moving average, which has now turned into resistance, as you can see by the wick of Monday's candle, before it closed below this support area, which I'm going to shade in orange on this chart. This area is now going to be very important in terms of resistance. For as long as it holds below this area, the path of least resistance would be to the downside. So I moved down to the psychologically important 5,000 level, cannot be ruled out at this stage. And if we were to break through that area, then the next downside target could be significantly lower from there, possibly this shaded blue area, which corresponds with the highs of the previous years, as you can see when I zoom out from this chart a little bit. This area was resistance back in January of 2022, and again on a couple of occasions last year before the index broke above it. So that area is going to be very important insofar as the longer term is concerned. But will we dip all the way down there? Remains to be seen. For now, the key level to watch is 5,000. And in terms of resistance, the shaded area is going to be very important. For as long as we hold below it, the bears will be happy and in control of price action. But if we go back above this area, I think that is going to be a game changer insofar as the short term is concerned. Now this is the Nasdaq chart, and previously I had highlighted the fact that the index had created bearish engulfing candles, large bearish engulfing candles in fact, on the daily time frame, but there was no downside follow through. Well, that changed, didn't it? Because on Monday the index broke below this key short-term support area, so now the short-term bias has turned bearish, the fact that we've broken below the zone. So we can refine our resistance levels more precisely. And I can move the shaded region a little bit higher just to incorporate the low from Friday and this low right here that was formed in mid-March. Let's color this in red to signify that this is a resistance area now, having formerly served as support. So from here, if the index continues to hold below here on a daily closing basis, the path of least resistance will remain to the downside, and we could well see a continuation lower towards the shaded area, which, similar to the S&P 500, marks the highs from the previous years. As I zoom out, you can see it quite clearly. Will we get to those levels remains to be seen, but for now, at least, it looks like the sellers are in control of price action unless we go back above this shaded red area. The euro dollar has bounced back following a sharp 5-day sell-off. Today we had better than expected German ZEW numbers from Germany, which helped to provide some support for the euro dollar. But with geopolitical concerns at the forefront of investors' minds. This is keeping the US dollar supported. So I wouldn't expect the euro dollar to stage a significant recovery from here unless something fundamentally changes concerning the situation in the Middle East. So from here, I think if we do see a bit more of a recovery, this is going to be a significant area of resistance between 106.95 to 107.25. This area had previously offered significant support back in December and again in February before breaking down on Friday. So once strong support, this area could turn into resistance moving forward. On the downside, the next level of support to watch is 106, the round handle, but I think the bottom of this bearish channel at around 105 is going to be a more significant support to watch should we get there in the next day or two. The dollar yen is continuing to rise and now it's approaching that 155 handle where the Bank of Japan or the Japanese Finance Ministry is likely to step in, or so that's what many analysts think might happen. If we do see intervention there, then we could see the dollar yen go back down, but the key area of support now is this breakout area around 151.90 to 152 handle. That area is now going to be significant support because previously the market had found strong resistance there on multiple occasions before this breakout. So any dip back into this area could well be supported. That's of course unless the Bank of Japan announces some drastic measures, for example, a surprise rate increase. Unless that happens, I don't think the dollar yen will fall significantly given the current macro backdrop, which is positive for the US dollar, thanks in part to strong data, rising oil prices, and raised geopolitical concerns. So looking at the long-term chart of gold here, you can see that the metal is still holding near its record highs, trading around the 161.8% Fibonacci extension level of this downswing that was created between August 2020 to September 2022. The relative strength index, the RSI, is at extremely overbought levels, but essentially the trend is clearly bullish. And if we see any short-term weakness, it could well be supported, for example, around this shaded region between 21.95 to 22.35 area, which is the first area of support on the weekly chart. For more analysis and trade ideas, make sure to check out the news and analysis section at cityindex.com.